All right, let's jump right in. Today, we are going to crack open one of the most powerful and, let's be honest, most misunderstood documents in the entire financial world. We're going to completely demystify the balance sheet, forget all the jargon, and do it in just a few minutes. So let's get to it. So, what if I told you there's a single piece of paper that could reveal a company's financial secrets? Not what they earned over the last quarter, but what they are actually worth right now, at this very moment. Well, that document is a balance sheet, and it is the absolute key to understanding how healthy a company really is.
Okay, so the first thing you've got to get is this. A balance sheet isn't a movie, it's a photograph. It doesn't show you the story of money coming and going over a year. That's a totally different thing called an income statement. No, the balance sheet literally freezes a single moment in time, giving you this perfectly clear snapshot of exactly where a company stands financially on one specific day.
Now, here's the official textbook definition. And yeah, it sounds a little dry, right? A statement of the assets, liabilities, and capital. Don't worry about it. We're going to throw out those confusing terms because to really, truly get this, you only need to understand two very simple ideas.
That's it. This whole intimidating-looking document is built on just two foundational ideas. Once you nail these down, I promise everything else just clicks right into place.
And here they are, assets and liabilities. Now, you've probably heard these words thrown around before, but we're about to lock in the simplest, most powerful definitions you will ever need. This is it. Seriously, this is the only rule you need to burn into your brain. An asset is anything that puts money in your pocket, and a liability, that's anything that takes money out of your pocket. Simple, clear, and unbelievably powerful.
Let's make this super real. You own a rental property, and every month, a check for rent shows up. That's an asset. It's putting cash in your pocket. But that car you're still paying off, the loan payment that goes out every month, that's a classic liability. It's actively pulling cash out of your pocket. You see the difference? It's all about the direction the money is flowing.
And this is why that difference is so incredibly important. This quote from Rich Dad, Poor Dad just nails it. You know, building wealth isn't really about how much you make. It's about what you buy with the money you make. Are you buying things that pay you or things that you have to pay for? So we've got these two big ideas. Things that put money in your pocket, and things that take it out. Well, the balance sheet gets its name because it takes these two opposing forces and puts them into one simple, elegant, and perfectly balanced equation. And that equation tells you what a company is truly worth. It all starts with the assets. You take everything the company owns that puts money in its pocket, and you pile it up on one side of the scale.
Then from that pile, you subtract all the liabilities, every single thing the company owes, all the bills, all the loans, all the debts. That's the other side of the scale.
And what's left over, what remains after you've paid off everything you owe, that's the equity. It's the real bottom line. You might hear it called net worth. It's the true value of the business. Assets minus liabilities equals equity.
And here's the best way to think about equity. Just imagine for a second that you sold everything you own, your house, your car, everything, and you got a big pile of cash. Then you use that cash to pay off your mortgage, your car loan, your credit cards. The actual physical money left in your hand after all that, that is your personal equity. It works the exact same way for a giant billion-dollar company.
Okay, theory time is over. Let's take what we've just learned and put it to the test with our real-world company. We're going to peek at the balance sheet for Johnson & Johnson and see this whole equation in action. Okay, check this out. Right at the top, we see that on this day, Johnson & Johnson had $11.3 billion in total assets. Now remember, that's everything they own that puts money in their pocket. So we're talking about factories, cash in the bank, patents, you name it.
All right, next up, total liabilities. This is everything they owed to other people, which came out to $56 billion. This could be anything from loans they took out to build those factories to money they owe their suppliers.
And now, here's the magic. You take the assets, that $113 billion, you subtract the liabilities, the $56 billion, and what do you get? $57 billion in total equity. That's the book value, the net worth of the entire company. And just like that, the equation balances perfectly. So knowing what a company's worth is cool and all, but the real power of the balance sheet is using it to look into the future a little bit. We can actually run a quick stress test to see if a company is healthy enough to survive the next year. This is the part that helps you make really smart decisions. We do this with something called the current ratio. Now, it sounds all technical, but trust me, it's just answering one really simple, really important question. Over the next 12 months, is more cash coming in than there are bills that need to be paid?
And to get that answer, we just zoom in on two specific lines on the balance sheet. First, current assets. That's all the stuff that's expected to turn into cash within a year. And second, current liabilities. Those are all the bills and debts that are due within that same year.
So let's go back to J&J. Their balance sheet says they have $57 billion in current assets set to come in over the next year. And they've got about $21 billion in current liabilities that they need to pay out. To get the ratio, you just do a little simple division. Assets divided by liabilities.
And that gives us this number, 2.68. On its own, it's just a number. But what it tells you, that's the powerful part.
So what does 2.68 actually mean? It means that for every single dollar that Johnson & Johnson owes over the next year, they have $2.68 in cash scheduled to come in the door. That is a very healthy cushion. It tells us they can easily pay all their short-term bills and still have plenty left over. Now that is the predictive power of a balance sheet.
So there you have it. In just a couple of minutes, you've learned how to read that financial snapshot, how to tell an asset from a liability, how to calculate net worth, and even how to stress test a company's financial health. We've unlocked the story hidden inside the numbers. So the only question left is, what story is your own balance sheet telling about you?